My dear students, I am Dr. K. Vijay Suganti, Assistant Professor, Department of Accounting and Finance, Tirthangal Nadar College. In this video, we are going to start with a new chapter, Dividend Policy, from the subject Financial Management. I am going to explain you what is dividend policy, theories of dividend policy. Let me explain what is the meaning of dividend. Dividend refers to that portion of profit which is distributed among the owners or shareholders of the firm. The finance manager has to take few decisions which are interrelated like investment, financing and dividend decisions. Dividend decision is related to the shareholders' share in the profits of the company. What is the meaning of dividend policy? A dividend policy can be defined as the dividend distribution guidelines provided by the board of directors of a company. It sets the parameter for delivering returns to the equity shareholders on the capital invested by them in the business. While taking such decisions, the company has to maintain a proper balance between its debt and equity composition. Next, I am going to explain you the theories of dividend policy. There are two theories of dividend policy. First one, irrelevance theories, and the next one is relevance theories. Under the heading irrelevance theories, we have residual theory and approach. Relevance theories, we have Walter's model and Gordon's model. Theories of dividend policy. First, I am going to explain you the meaning of irrelevance theory. According to irrelevance theory, dividend policy do not affect value of firm, thus it is called irrelevance theory. There are two theories, residual theory and approach. What is relevance theory? According to relevance theory, dividend policy affects the value of firm. Thus it is called relevance theory and we have Walter and Gordon's model. Next, I am going to explain you about the irrelevance theories. The first one is residual theory. According to this theory, dividend policy has no effect on the wealth of the shareholders or prices of the shares, and hence it is irrelevant so far as the value of the firm is concerned. This theory regards dividend policy merely as a part of financial decision because the earnings available may be retained in the business for reinvestment. But if the funds are not required in the business, they may be distributed as dividend. Thus, the decision to pay dividends or retain the earnings may be taken as a residual decision. What are the assumptions of this residual theory? The assumption is that raising financing from external sources involves higher cost. This can be explained with the help of example. Suppose A Limited wants to raise rupees 10 lakh additional funds to finance an investment project and its flotation cost is rupees 1 lakh. A Limited has to raise rupees 11 lakh from issue of shares so that the net proceeds with the company remains rupees 10 lakh after paying flotation cost of rupees 1 lakh. It means that the issue of new capital is more expensive than financing the project through retained earnings. The dividend will be paid only after using available profits for investment decisions. This referred as residual theory of dividend. Next theory is approach, that is Modigliani-Miller approach. Argued that firm's dividend policy is irrelevant to the value of the firm. According to this approach, the market price of a share is dependent on the earnings of the firm on its investment and not on the dividend paid by it. Earnings of the firm which affect its value further depends upon the investment opportunities available to it. What are the assumptions of approach? Perfect capital markets. This theory believes in the existence of perfect capital markets. It assumes that all the investors are rational. They have access to free information. There are no flotation or transaction costs and no large investor to influence the market price of the share. No taxes. There is no existence of taxes. Alternatively, both dividends and capital gains are taxed at the time rate. Fixed investment policy. The company does not change its existing investment policy. It means whatever may be the dividend payment, the company will make investment as it has already decided upon. If the company is going to pay more amount of dividend, then it will more equity shares and vice versa. No risk of uncertainty. All the investors are certain about the future market prices and the dividends. This means that the same discount rate is applicable for all types of stocks in all time periods. Investor is indifference between dividend income and capital gain income. It is assumed that investor is indifferent between dividend income and capital gain income. It means if he requires total return of rupees 500, he may get rupees 200 dividend income and rupees 300 as capital gain income or reverse. In either of the case, he gets equal satisfaction. What is the formula for approach? The formula is PO is equal to 1I by 1 plus KE into D1 plus P1, or we can use another alternative formula, that is DI plus P1 divided by I plus KE, where PO is current market price of the share, KE is equal to cost of equity capital, D1 is equal to expected dividend at the end of the year, P1 is equal to expected price of the share at the end of the year 1. Next, we are going to see about the relevance theories. Under the relevance theories, the first model is Walter's model. According to Walter's model, value of the firm depends upon the firm's earning level, dividend payout, constant reinvestment rate, and the shareholders' expected rate of return. The model suggests that dividend policy of the company depends upon the fact that whether the firm has got good investment opportunities or not. If the firm does not have enough investment opportunities, when it will pay the dividend, otherwise it will retain the money. If the firm pays dividend, then shareholders invest the dividend income to get further return. The expected return on reinvestment of dividend income by shareholders is called the opportunity cost to the firm, or the cost of capital of the firm. On the other hand, if dividend is not paid, then the firm will reinvest the retained earning for its future growth. The expected rate of return on reinvestment of retained earnings is called rate of return. What are the assumptions to the Walters model? The first point is internal financing. All the investments are financed by the firm through retained earnings. In other words, retained earnings are the only source of finance. This means that the company does not rely upon external funds like debt or new equity capital. Constant IRR and cost of capital. The internal rate of return and the cost of capital of the firm are constant. The business risk remains same for all the investment decisions. Constant EPS and DPS. Beginning earnings and dividends of the firm never change. Though different values of EPS and DPS may be used in the model, but they are assumed to remain constant while determining a value, where EPS is earning per share and DPS is dividend per share. 100% retention or payout. All the earnings of the company are either reinvested internally or distributed as dividends. Infinite life, the company has an infinite or a very long life. Next, the formula for Walter's model. Formula is P is equal to D by KE plus R by KE E minus D divided by KE, or you can use alternative formula D plus R by KE E minus D by KE, where P is market price of equity share, D is equal to dividend per share, E is equal to earnings per share, R is equal to rate of return on investment of the firm, KE is equal to cost of equity share capital, and value of the firm is equal to N into P. What is N? N means number of outstanding equity shares and P is market price of the equity shares. Next, under relevance theory, we have Gordon's model. According to Gordon model, dividend policy of a firm is relevant and can affect the value of a firm. Like Walter's model, value of the firm under this method also depends upon the reinvestment rate and shareholders' expectations. This is based on the premise that the investors are generally risk averse and prefer to have current income, that is dividend. Hence, there is a direct relationship between the dividend policy and the value of a firm. What are the assumptions of Gordon's model? The first point is no debt. The model assumes that the company is all equity company with no proportion of debt in the capital structure. Next point is no external financing. The model assumes that all investment of the company is financed by retained earnings and no external financing is required. Constant IRR. The model assumes a constant internal rate of return, ignoring the diminishing marginal efficiency of the investment. Constant cost of capital. The model is based on the assumption of a constant cost of capital, implying the business risk of all the investments to be the same. Perpetual earnings. Gordon's model believes in the theory of perpetual earnings for the company. Corporate taxes are not accounted in this model. The model assumes a constant retention ratio, that is B, once it is decided by the company, since the growth rate is equal to B into R. The growth rate is also constant by this logic. K is greater than G. Gordon model assumes that the cost of capital and growth rate, this is important for obtaining the meaningful value of the company's share. What is the formula to calculate market price of the share under Gordon's model? P is equal to E within bracket 1 minus B close the bracket divided by KE minus BR, where P is equal to market price of equity share, E is equal to earnings per share, B is equal to retention ratio, R is equal to rate of return on investment, KE is equal to cost of equity capital, BR growth rate of the firm. Hence, value of firm is equal to N into P, where N is equal to number of outstanding equity shares and P is equal to market price of equity shares. Students, I hope now you understand what is the meaning of dividend policy, and about the theories of dividend policy. Thank you for your patient listening.